Welcome to Buy, Hold, Sell, brought to you by Livewire Markets. My name is Vishal Texlani. Finding small and mid-cap stocks shouldn't be all about growth. You've got to back companies that have strong cash flow, good balance sheets, and the ability to fund their own destiny so that they don't keep coming back and begging you for capital. That's why in this episode, we are going to run the ruler over 5 stocks, and plus my guests are going to bring one name that they think ticks all the boxes and maybe has a special kick to it. Joining me are David Allingham from Eli Griffiths and Marcus Burns from Speria. Gentlemen, welcome.
Thank you.
All right, Marcus, I'll kick off with you. Ansell, a global leader in packaging and protective equipment. Buy, hold, sell.
I'm a holder of that. The reason being, I think it had a good run post its acquisition from J&J, but it's re-geared the balance sheet, and ex the acquisition, it's pretty modest growth, and I think it's pretty fully priced.
David, the stock is up around 40% over the past year. It's had a really good run. Is it going to run out of steam? Buy, hold, sell.
Look, I'm still a buy. I agree with Marcus. I think there's 2 things happening here. Marcus is right. The acquisition has enhanced the short-term earnings profile of the business. There's also quite a large restocking cycle happening post the COVID sort of adjustment within particularly gloves and hospital wear. So I think that's still got a little bit more to play out. I think they're very likely to upgrade or be at the top end of their guidance range this year. So I think the stock's a good place to be. It's sailed through this sort of geopolitical dynamic quite well the last few months. But I think with Marcus is right, you know, as we move into 26 and beyond, more cautious. Moving on to Lovisa. Over 900 stores across 45 countries. It's become quite a global beast. Buy, hold, sell. I'm a buy on this name. Look, it's rare that you get a high quality business that has a lot going wrong at once, which has led to very heightened uncertainty. Comp growth deceleration due to reopening, store rollout slowing, change in CEO. You know, there's a competitors opening up. You know, there's a lot worrying the market, but you've got the stock now on a multiple that hasn't really traded on for a long time. So I think that's a great risk reward equation. So I'm a buy on that name.
Okay, Marcus, do you agree? It is down 20%.
It is down. Look, I'm going to take the other side of that coin for a change. I think it's a sell. Look, it has done a great job rolling out stores. It's very high margin, but I think it's actually the problem long term is it's extremely high margin business. I think there's no barriers really to compete with them. So I think strategically it's easy to compete with the business. So high multiple, low barriers, high margin, I think that's quite risky. And so I'd put a sell.
Disagreement on that one, but let's turn to Breville, a great Australian success story. Its stock is up around 25% over the past year. Perhaps lots of people buying their own coffee machines to save money. Buy, hold, sell.
Exactly, yeah. Look at the old inflation buster. I'm a buyer of Breville long term. I think it's got probably one of the best management teams in the country. They reinvest very heavily in R&D and also advertising. Very long-term vision, good cash flow, incredibly good balance sheet, demonstrable market share gains, both domestically and internationally. So I think to me it's a long-term buy.
Okay, Marcus puts a strong case for it. Do you agree, David? Buy, hold, sell?
No disagreement on this one. I agree too. All I'd add is I think, you know, this company has proven that it's investing well ahead of the curve. So if you look what it did during COVID, it took that incremental work from home revenue that it saw and reinvested in new product development, marketing, going direct to the consumer in many new geographies. And so I think what Jim, and we agree, one of the great CEOs, another agency example, but you know, this company's now set up for many, many years of sustainable earnings growth. And that's what we really like about it.
All right, our first double buy. All right, next on the list is Charter Hall, a name synonymous with the REIT market. Buy, hold, sell.
Charter Hall is a buy for us. It is actually our preferred asset manager play at the moment in the Aussie market. And really that's dictated by the fact it operates to a very different cycle than the equity asset managers. So if you look at the great businesses of the Pinnacles and the Magellans and the Platinums, that, you know, they're inherently linked to equity beta. We think Charter Hall's asset base is more linked to the property cycle. We know that. And so we actually think that's finally turning the corner. We're going to see that dynamic play out and see Charter Hall grow over the next couple of years more than the other managers.
Okay, Marcus, turning to you for Charter Hall. It's up 25% over the last year. Maybe lots of employers asking their staff to come back to the office. Buy, hold, sell.
Look, I don't want to be too agreeable with David, even though I think he's obviously a very sound investor, but I think it's a buy as well. You know, good balance sheet, good mix of property funds management and actual tangible assets. Rates have finally been cut in Australia, which is supportive of asset valuations, and a pretty modest and attractive valuation with great cash flow dynamics. So I'd put that on a buy as well.
Okay, number 5, Supply Networks, which provides aftermarket parts to the commercial vehicle industry. Buy, hold, sell.
Sounds attractive, doesn't it? Look, we're a buyer of this stock, and we have been for some time. It's probably market leader in the aftermarket supply of truck and bus in Australia and New Zealand. It's grown probably one of the best organic growth stories in the country over the last decade. It's grown revenue something like 14 to 15% CAGR over that period, all organically, so no acquisitions at all. ROE is incredibly high, around 35%. Balance sheet's net cash or almost net cash. So, and again, a really good CEO who's he's not a founder, but he acts like a founder. Has re-rated, but the future still looks really bright for the company. So we're a buyer.
Okay, Marcus is a fan. Are you, David?
I'm definitely a fan. We'd be more of a hold on that name. Only Marcus mentioned valuation. I think we've got to be mindful of that. But what's attractive to us is that market share gain again. They're ticking over. It looks like around 100 bips of market share. They're only 12% of the market. They've got a long runway for growth, but that is price. So we'd be a hold on that name.
All right, thanks, gents. So my favorite part of the episode, I asked each of you to bring me one stock that ticks all the boxes, plus perhaps it's doing something exceptional. David, what have you got for me?
I would put forward Temple & Webster as a name. Little quirky, I think. It's at the pointy end of growth, so I acknowledge valuation is high at the moment, or rich. But I think when we talk about balance sheet and flexibility around that balance sheet that gives companies optionality, this company's a prime example. Around 130 of net cash on the balance sheet, there's potential for M&A down the path. But really why we like this name and why we think it's a lot higher over time is the market share story. They're only 3% of the Australian furniture market. They grew that market share 20% just in the last 12 months. We see a long runway for them. They've got a target of $1 billion of revenue in time at 15% EBITDA margins, and we think they'll grow above and beyond that as well. So, we think it's very well positioned with that balance sheet flexibility too.
Nice one, mate. They've got more money than they probably know what to do with. Do you have something with an equally strong balance sheet, Marcus?
Look, I'm going to bring AP Eagers, which is a car retailer, to the table here. It's the leading car retailer in the country with a 10-12% market share. It's growing both organically through rolling out some new locations and also through acquisition. It's got the BYD franchise in Australia, which I think will probably do incredibly well in terms of taking shares. So they're launching attractively priced Chinese-made EVs and hybrids, and they're doing really well. Balance sheet's really strong, so it owns $880 million worth of property around the country. And if you look through that, look through the sort of cash flow, it's a good generator of business. So good market share gainer, good cash flow. Balance sheet's really strong, and I think valuation's also pretty supportive.
Gents, thanks for your time and your views on these stocks.
Thank you.
Thank you.
I hope you enjoyed that episode. Strong balance sheets and even stronger opinions, just the way we like it. My name is Vishal Texnani. Don't forget to like this video and subscribe to our channel. Happy investing.